Okay, good evening, everyone. Uh, Thank you for finding the time on an afternoon to join us for this specific session. Before we dive into angel investing and get the benefit of hearing from Anil, a quick introduction about Jiraaf. Use some slides. Yep, for those of you who know us, a small introduction, and for those of you who are new, Giraffe is effectively a platform offering fixed income opportunities between the 5 to 20% yield and the 30-day to 3-year tenor. We deal in various instruments, which is commercial paper, corporate debt, supply chain financing, leasing, and venture debt. So if any of you or your clients would like to join the platform, they can then avail opportunities that allows them to create a fixed income portfolio across the tenor and yield bucket. The founders here are Saurav Ghosh and Vineet Agarwal. Both of them have experience in financial services, each for about a little more than a decade. And then we've got the core team, which is myself, Vikas, JP, and Apurv and Vasu, who have all come with rich experience from the financial services domain. We've raised a little bit of money from Axel Partners, which is a renowned VC firm, and from various other entrepreneurs, successful entrepreneurs who have supported us in their journey. What really we are trying to do is we believe that the alternate investment space in India is widening. There are various asset classes that have come up. And while there is fixed deposits at the one end and very risky investing at the other end, there is a wide scope for fixed income opportunities in the middle. And that allows an investor to move away from a little bit of market risk and participate in credit risk and build a much more robust portfolio. There have been various global studies that indicate that having 10 to 20% of portfolio in alternate investments is a very good benchmark to follow. And that's what we're trying to bring together at Giraffe. Some of our products and the kind of yield at tenor ranges brackets you will see now on the screen. As a matter of track record, now we've been operational for a little over than a year. We have done more than 250 opportunities that have gone live on our platform. Purely in terms of volume, we have now disbursed over 800 crores across about 35 borrowers. Investors on our platform have participated for that amount. We have now about 45,000 investors registered with us, out of which about 10% of them would have already participated. We're a team of 70 people, largely based in Bangalore. Some of our colleagues are also based in Mumbai. We have now about 350 IFAs partnering with us and helping expand this ecosystem. For this specific session, though, we have the privilege of being joined by Anil Gudibande, who's been a very well experienced banker. His early days were in Citibank and then with Royal Bank of Scotland. But for the last 6 years, he's been heading a very interesting outfit called OneCrowd that has been spearheading angel investing in the ecosystem. Maybe I can request Anil, if you would like to introduce and then guide the session towards angel investing and what OneCrowd is about.
Great. Thank you so much, Prateek. And I'd like to thank you and all your colleagues at Jiraaf for this honor. It is indeed my pleasure to be presenting to each of your platform members and customers. Good evening, everyone. My name is Anil Gudibande, and I am one of the co-founders of OneCrowd. As Prateek mentioned, I cut my teeth in financial services in banking and spent a fair bit of time across the investment banking landscape, first as a trader and then as a mainline investment banker. And about 7 years ago, along with a few other professional bankers, we set up OneCrowd. And we have had the pleasure of working with several founders, several investors in the angel investing space. And today, OneCrowd is a early stage venture investor with an AUM of about 200 odd crore rupees across about 35 odd startups. And our sweet spot is to invest about 3 to 4 crores in each startup in each round after a thorough diligence on them. and then work very, very closely, almost like a venture capital firm, in working with these startups that we've invested in and ensuring that they meet with their objectives. So with that introduction, I will start off first by talking a little bit about angel investing, and then we'll come to what I'd call the instrumentality through which you can actually invest in opportunities through the One Crowd Fund. But first, on the basics, what is angel investing? Angel investing, in its simplest form, is investing in early stage startup opportunities, as they are called, by people who may or may not necessarily be professional investors, but who want to ride a risk reward curve that tends to offer returns that are disproportionate to the amounts that are being invested. So what does this mean? In simple words, it means the opportunity to identify a company called a startup in common parlance, and investing small tickets, sometimes as small as 5 lakhs or even lower, and then riding the risk reward wave on that to try and see whether that can give you disproportionate returns over a period of time, right? This is not a lottery. This is not greed versus common sense. It is none of that. It is it is at the very basic level, it's a very systematic approach, almost as systematic as SIPs are in investing in the public markets and being rewarded for the risk that you take, with a disciplined approach. So angel investing is identifying an opportunity, being able to participate in that opportunity, in the equity of that opportunity, by cutting a small check, and then growing a portfolio of such opportunities, because this is a market where, unlike other financial instruments, this is a market where you tend to make money just on a few investments within your portfolio, and therefore it follows what is called the power law, i.e., you make an investment in 100 companies, maybe 10 will give you outsized returns, and out of the balance 90, 70 may go down the chute, 20 may meander, right? So that's really the power law at play, and angel investing is about making use of that to your advantage. So select opportunities, look to build a portfolio, and then ride the risk reward continuum in profiting from your portfolio. So how does one do this? Again, very simply put, you could build a private portfolio because enough number of people come to you and say that, hey, if you've got some money, can you come and take a look at my startup and invest in it? And there are many people in the community who are in a position where young entrepreneurs go to them and ask for help, financial help. The other way of doing it is to have a network of your own, and via that network tap into opportunities in the market. Now, unfortunately, these two modes aren't available to everyone, because most people are very busy with their business, with their profession, and have so many other things that occupy their minds that they don't have the time and they don't have the ability perhaps to make that effort to go out and solicit opportunities like this. So what do people do then to access these opportunities? They come to people like One Crowd. And what does One Crowd do? Like I explained to you, we have developed products and processes for investors like yourselves and your clients to come and via our products access these opportunities. We in turn have built roads into the market so that we can tap into these opportunities via relationships with incubation centers in India, via our own personal networks, via professional networks, and certainly now that we've been around for the last, call it 7 years, there are enough number of people who directly approach us. And then we follow a very disciplined approach of how we make selection. One Crowd as a philosophy tends to look at opportunities that are, on the cusp of knowledge and technology. And if we find opportunities which meet these two criteria, that fit these two dimensions, then we begin to see whether those founders are founders whom we can work with, whom we can back, whom we trust, and who we believe can carry this company, this opportunity to success. Once we've made that determination, the rest of it is process. How do you do diligence? How do you do your business diligence? How do you do financial diligence? How do you do legal diligence? Where do you pull in professionals to help you do this, et cetera, et cetera. And then at the end of it all, you agree on a set of terms and conditions with the founding team, with the company, and then get started on the investment. Now, in all of this, the entire process of identifying an opportunity to actually cutting a check is about 5% of what it takes to make money from angel investing. Your real work starts after you make the investment, because that's when because that's not the trophy. The trophy is the exit. The trophy is a successful company that can give you a multiple return on the money, that can give you a return on the money you've invested, and hopefully a big multiple of the money that you've invested. And therefore, that is where people like One Crowd come in, because we come in with a very powerful value proposition that not only helps in the initial process of finding an opportunity, assessing it, analyzing it, going through the process of actually making the investment, but most importantly, in actually mentoring and working with the founding team and monitoring progress very, very closely to try and see whether we provide the startup the best possible opportunity of success. Now, obviously, we are not magicians. We can't make everything work. But what we can do is to ensure that any chance of failure for the wrong reason is minimized, and therefore, on the flip side, the chances of success are maximized, right? So that's really, in a nutshell, what angel investing is about. I will now talk about One Crowd and our product, the One Crowd 0 to 1 fund, because I think we have devised that product precisely for people like you who are interested in angel investing and who would want to benefit from a disciplined, consistent, sort of bounded approach to it. So like I said, we are a seven-year-old firm. We bought about 200 crores of asset under management. And very recently, we acquired from SEBI a registration to offer the One Crowd 0 to 1 fund. It's what is called an angel fund. And what that means is that when we invite members of the investing community like yourselves to join our fund as contributors or limited partners, as contributors to the fund, we will go out there into the market and try and curate opportunities for the fund to invest in and bring those opportunities after a thorough diligence to you. And we would then offer that to all investor members on our fund. So if each of you becomes a LP or a contributor to the fund, you'd be an investor member in the fund. And we would then show you these opportunities for you to then choose whether you would want to make an investment in them or not. Right? So there is a very, very important element of discretion that you would have, and that is to choose the startup in which your money is going to be invested. Because there is choice, that means that you can say yes, in which case some part of your commitment will be invested in that particular opportunity. And if you were to say no, then no part of your commitment is invested in that particular opportunity. And you can say yes and no to any number of these opportunities as they keep coming. So the One Crowd 0 to 1 fund has been established to provide you an access to these opportunities in the angel investing space. We are SEBI registered and therefore a regulated entity. And what that means for you is that there are a set of rules and regulations that both we and you have to follow as laid down by the Securities Exchange Board of India in helping us with our investment objectives. Can we go to the next page, please? Yeah, thanks. Now, this is the structure of the 0 to 1 fund. As you can see, each of you would be invited to participate as contributors or limited partners, as they are called in the parlance of the industry. And you would then be invited to participate in the fund. And you would have to sign up a contribution agreement, which will then obligate you to make a certain minimum investment over a period of time. Now, once you've made that commitment, we, as in the One Crowd management team, will go out and scout for opportunities. These may be opportunities from within our current portfolio, or maybe new opportunities, or maybe a combination of both. And we will then identify them and run a process through which we make a determination that this is indeed a company that we would like to support with an equity investment. Once we've made that determination, we will come and present that opportunity to each of you who have committed to invest in the fund. And you will then have the choice, i.e., you make an election to invest in that particular opportunity or let it pass. Some of you can make a positive election, i.e., you can say yes to it. Some may say no to it. But as long as enough number of people have said yes to it, we would have enough money to invest in that particular opportunity. And mind you, this money that is going in will be taken out of your commitment. And when you make the commitment, you don't part with any money at that point in time. You part with money only when you make an election to invest in a particular opportunity, and you then allow, or you only remit as much as is required to satisfy the amount that is going into that particular opportunity. So each of these opportunities then becomes a scheme of this fund. And therefore, for a particular investment opportunity, we would have a unique scheme that is identified and that is presented to you. Our typical presentations are on a webinar like what we are doing today, where we invite the founders of the company to come and make a presentation alongside presenting all the terms and conditions. Typically, all the paper is pre-circulated, usually a few days in advance. And then on the webinar, you would have a chance to hear the founders talk to them, ask them questions, listen into their answers, etc. All of which is recorded, and the recorded versions then are made available to those who, for whatever reason, couldn't attend the main meeting. Once all of this has happened, we would allow a couple of weeks for each of the investors to make a call whether they'd like to invest in that opportunity or not. And if they do so, choose to invest, then we make a drawdown of the amount of money that they have committed to that particular opportunity, and then the transaction is complete. Now, like I said, all of this is just the initial steps in an investment. The real work starts after we've made the investment, when the OneCrowd team and the founders and the advisors, etc., who we put together, begin to work with the founding team and the employees of the company to make a success of that organization. So this is not a game that can result in big returns overnight. It typically takes a while. So patience is the name of the game, really. But over a period of time, it is our experience and the experience of some of our seasoned investors that this can be perhaps the best asset class that you could ever invest in terms of risk, reward, and return. If you can go to the next page, please. So here are a set of pre-approved names that we have, which are readily available. In the sense that these companies are companies, most of them, the ones shaded in the green, are the companies that are companies in our current portfolio, and we've worked with these companies for the last several years. So we are very, very familiar with them. We have hands-on experience of how the founders run their businesses, etc. And these are companies that are looking for the next round of capital to fund their growth, and we are more than happy to support them. So in some sense, these could be opportunities that are readily accessible. Of course, there would be a issue on timing. Some of them may want their money only a few months from now, whereas the others may have to wait maybe a little longer, and some are more immediate. There are some which are shaded in the yellow. These are companies that are new to our stable, but we have already spent a bunch of time with them. They've all passed our investment committee's scrutiny, and we are in the course of figuring out when we can bring them onto our fund and to if we can move on to the next slide. So why should anybody look at the 0 to 1 fund, and what is the real proposition that we are bringing to the table? Like I said, you're on the risk reward continuum, and Prateek spoke about a fixed deposit or a bank product being the least risky, but also giving you the smallest return, and then talking about products that tend to be higher on the risk spectrum, but certainly reward you a lot more in return terms. So if I were to extend that continuum, we will come from bank deposits and PPF and various other sort of low risk, low reward products to the higher risk, high reward products, which tend to be maybe some of the debentures that you have in the market or other fixed income products. And as you go up the risk scale, you will come to equity. And within equity, you have products that tend to be in the listed space, and therefore they are liquid. And then those are in the unlisted space that tend to be very, very illiquid and therefore come with a whole bunch of different kinds of risks. We are in that category. So we are, in some sense, in the highest risk category, but equally, the expectation is that the reward is also the highest. So how do you then play this? One way of doing it is to try and see whether you can minimize the amount of capital that you put in the very early stages of an investment, and slowly but definitely expand your exposure to the names that are doing better and better. And that's where a fund approach like the 0 to 1 fund is very, very appropriate. And it's appropriate because, one, the 0 to 1 fund today has access to the entire OneCrowd portfolio of about 35, 40 investments. We have the benefit of bringing transactions where the OneCrowd team has lots of experience in dealing with those opportunities and dealing with those companies. And therefore, on a plain sheet of paper, I can say that the risks involved, or the risks that you'd be exposed to in making those investments, would be much, much smaller. Two, there are other names that we can bring to the table, which may not be existing portfolio companies, but which may be companies that have already been in the market or in business for some time. And therefore, over a period of time, a lot of the early stage risks are fully absorbed. And therefore, they become less risky propositions. So let's say you're talking about companies that are raising capital in the Series A bracket or beyond. And then there are companies which may be companies that are very, very early in their stage of evolution, that have come to OneCrowd and want some money to try and make their propositions reality. And this is where we would start with giving them small doses of capital. And as they build out and advance on their own evolution curve, we then begin to put more and more money behind that. So this is how traders work. Traders build positions. No trader, no matter how big, how rich, whether they're institutional, non-institutional, no trader goes and jumps into a very big position straight away. They all build position. So the 0 to 1 fund is designed to help you build a bespoke risk reward profile, because you can choose the investment that you want, you can choose the stage of evolution that you want to invest in, and you can then begin to back your winners once they begin to emerge, as this curve suggests. Next page, please. So this is one of our more active investors. With his permission, we've been able to show you the profile that that investor has on our platform and with our investments. This particular investor started, I think, investing small tickets, but in a fairly large number of opportunities. So, out of the total amount of almost 3 crores that the investor is invested, about 1/2 was invested in first round opportunities that investor got to access. From there on, the investor kind of, with our help and our assistance, we were able to filter out investments that were doing better and better. Those companies were progressing, in their own plans. And as they looked for more money, that investor began to invest more. And as you can see, the investor has peppered capital across round 2, 3, 4, and 5, and has built a total portfolio of about a little short of 3 crore. This is at cost, i.e. the price paid at the time of the investment. Now, if we were to run a fair mark to market on this, and mind you, most of these investments have been around for less than 3 years because they are all very young companies. In a 3-year time frame, perhaps the MTM on this portfolio is about 6 odd crores. So it's a gain of a couple of times in under 3 years, giving an IRR of greater than 30%. Now, the reason why we have specifically shown this is because it tells you what you can make in a reasonably short period of time once you follow a disciplined approach in angel investing. And that's the reason why you would come to OneCrowd. That's the reason why you would choose a product like the 0 to 1 fund. Next slide, please. So in the last 7 years that we've been in existence, we began actually investing in February 2016. And the initial couple of years were rather slow. But from the summer of 2018, we speeded up building our portfolio. And in the last couple of years, or the last 3 years, right through COVID, in fact, much of our portfolio was built. We currently have a portfolio of a little less than 200 crore at cost. And we think that on a mark-to-market basis, that is up over 2 times. Of that 200 crore portfolio, a part of that has been invested from our current fund, which is a micro fund about 60 crore in size. That is now done and dusted. It's almost fully deployed. That's why we have launched the new fund called the 0 to 1 fund. The balance part came from an open platform, angel network that we ran. And that entire angel network today is being morphed or flipped into the new fund. So we will have no more open angel network left now that we have the fund. So anybody who's interested in participating in OneCrowd's portfolio of investments will have to come through our new fund, which is the OneCrowd 0 to 1 fund. Next slide, please. Key terms of the 0 to 1 fund, like I explained, each investment opportunity is a separate scheme. So all investors, when they commit capital to the fund at the very top, and the fund then begins to deploy the monies in each of the schemes. And you, as an investor in the fund, will have the ability to choose which of these schemes that you really want to be part of. The minimum investment is 50 lakh rupees in terms of commitment to the fund. And once you commit anything at the minimum or above, each of the investments that you make will have to be in a minimum size of 5 lakhs. So if you identify a particular scheme and you like that particular scheme and opportunity, you would have to commit, you would have to invest at least 5 lakhs from the amount that you have committed to the fund. The sponsors, that is OneCrowd or our management company called Zeva Capsol, will invest in each of the opportunities, and we will invest at least 5 lakhs in each one of them. So while the SEBI mandated minimum is for us to put in at least 50 lakhs over the life of the fund, it is very likely that our overall commitment to the fund will be significantly more than that. Because this is a fund where each investment is a separate scheme, we can do schemes over a long length of time. And that length of time is about 15 years. We have 1 year to sort of announce our first close, as it were. The first close is the date by which the minimum commitment that we need in the fund is raised. The SEBI mandated minimum is 5 crore, but we think that our first close will be for an amount significantly higher than 5. But over this time, we will be free to bring opportunities to the table. Each opportunity will be a separate scheme, and you as investors in the fund will be able to choose these schemes and invest a minimum of 5 lakhs in each scheme. The drawdown will be only upon your election to invest in a particular scheme. So at the time of commitment to the fund, you pay nothing. But at the time of actual investment in a scheme, that is when we will draw down a part of your commitment. Because we are structured as a AIF, the income tax rules that apply are the pass-through rules. So our AIF is a pass-through, which means that you will end up paying taxes as if you were a direct investor in those companies. So this is perhaps the most efficient structure that, from a tax perspective, that can be devised, under Indian regulation. Can we go to the next page, please? Yeah. So this is the commitment and fee structure. Like I said, the minimum commitment is 50 lakhs. So we've got a 50 lakh to 1 crore bucket, a 1 crore to 5 crore bucket, a 5 to 15, and a 15 crore and beyond bucket. For each of these, the economics differ slightly. There is a 2% management fee that is paid on each of the investments that are made, and we collect the fees for a block of 5 years in one go. So that means if you have committed 50 lakhs to the fund and you have elected to invest in an opportunity with 5 lakhs, then 10% of that 5 lakhs, or 5 times 2%, which is 10, 10% of 5 lakhs is what is taken as fees, and the balance is what is invested in the company. There is a 20% profit share, or a 20% carried interest, as it's called in the market, and we do offer set off. What does set off mean? Set off means that should you make a series of investments and one of them results in an exit at a profit, we will take our performance fee only after we have deducted the entire amount of investments made up to that date. So effectively, we are ensuring that your profits pay for your investments before you pay us anything, right? And the management fee is fixed for at 2% per annum, but taken for a 5-year block each time, up to 5 crore. But for amounts above 5 crore, there is a reduction in management fee, as you can see. The carried interest is, or the profit share, is 20% for amounts of 50 lakhs and up to 1 crore. From 1 to 5, we brought it down to 17.5%. And then there is a reduction, for those who participate with 5 crore or more, but up to 15, where the carried interest is 15%, and then it comes down to 10 for amounts that are over, commitment amounts that are over 15 crore. So that's really the commercials of this proposition. Can we go to the next page, please? Yeah, we've illustrated the fee structure over here and how that works. As we have more discussions with those of you who are interested, we can go through the finer details. Suffice to say that we have to pay GST on this, so GST is included, and we have also shown how the set of works in practice if you were to make a few investments from your commitment amount. Next page, please. These are the advantages that I've already spoken about of investing in our fund. The One Crowd 0 to 1 fund really provides for a very disciplined approach, simply because we have an infrastructure that is now 7 years. We have lots of experience in working with 35, 40 startups. We've invested about 200 crores in them. And therefore, from deal origination to diligencing, to the investment process, to monitoring, to mentoring, and finally to look at exit opportunities, all of it we cover. We have a very robust IC that overlooks much of our activities. We have a bunch of mentors who work closely with us and our startup investments in helping them scale. And most of all, we have grown a level of trust between the founders and ourselves, which is oftentimes defining in getting the startup to go through the various cycles in the market to success. Next page, please. These are the value additions that we spoke about, so I won't spend more time on this. But suffice to say that the idea behind the entire effort is to stick to a disciplined process. That's what you do even in something as simple as a SIP. But that's really the kind of discipline that you need to follow in any kind of investing, certainly in angel investing. Next page, please. This is our team. Alongside me, my co-founder, Anup Kuruvilla and Natasha. We have a very strong team, highly talented, highly experienced. Giri, Kalpana, Vidhi, Bhavi, Hriday, Niyati, Vrithi, and we're growing our team because we think that, and Sharan, and we think that it's important, to have the right kind of people face off against the right kind of opportunities. So that's how we have grown our team. It's been an absolute privilege to have had Prateek, having been a partner and a senior member of our team until recently. But Jiraaf is lucky now to have him. But yeah, that's really the team behind One Crowd. Next page, please. Our directors, we have some of the sharpest minds from banking, financial services, and the infotech world with us. Dr. Ganesh Natarajan, Sujit Banerjee, M.A. Ravi Kumar, Neerav Jugani. They come with diverse sets of experience to join some of us who are on the board from the management side. So that's our board of directors. Next page, please. Portfolio details. I've already spoken about several of these companies when we showed the slide on the kind of companies that are making it to the next level. I'll speak about one opportunity which is called Minvax. If you could just run down to that opportunity, maybe I'll just spend a few minutes talking about Minvax, because that is going to be one of the first opportunities or the first schemes under the new fund. Minvax is if you can just scroll down, perhaps you can get to the Minvax. Yeah, scroll down a little more. Yeah, this one. So Minvax is a absolutely awesome opportunity in the biotechnology space. It's a vaccine company. And as we all know, because of COVID, suddenly vaccine and vaccine technologies have become household names. Minvax is a vaccine company that has two broad programs, one for influenza and the other for COVID. They have a couple of others that are under development, but we'll focus on the first two. Their approach to the market is to create products that don't require essentially a big infrastructure to move those products around before they are made available for human consumption. Today, if you look at many of the vaccines that are there in the market, whether they are the mRNA type or or from other technologies, they all require a significantly expensive cold chain to move them from the point they are manufactured to the point that they are consumed. mRNA, for example, requires anywhere between minus 30 degrees and minus 70 degrees to store and transport these vaccines, which makes it enormously difficult, not to talk about the cost, in making it available in most parts of the world. There are other vaccine technologies that produce vaccines which require a cold chain that goes to as low as 4 degrees centigrade. In many parts of the world, this may not even this may not be available. And therefore, in a fast expanding market, you find that the current products don't have the kind of infrastructure to reach and be of benefit for people to consume. And that's where Minvax has stepped in to use technology. They have developed their own unique technology to try and see whether they can produce products, vaccine products, to fight influenza and diseases like COVID that don't require the cold chain, that are of a technology stream that creates products that are very, very stable and have long efficiencies, unlike the current set of vaccines where you may have to keep on going and taking booster doses or have to frequently update the vaccines before you can actually benefit from them. Just give me a second. I need to. I just need to switch my my Wi-Fi provider. Just 1 second, please. Sorry, is this clearer? Is my voice? Yeah, thanks, Prateek. I can see your thumbs up. Yeah. So really, what Minvax has been able to achieve is something very unique. There are others in the market who are also trying it, to be honest, but they've made substantial progress. Their vaccines for the influenza disease is about to hit phase 1. They're carrying it out in Australia. It will take a few months. It will start by about middle of January 2023. And for COVID, they will start the trial sometime, the phase 1 trial sometime in the first quarter of 2023. That means anytime in the Jan-Feb-March months, which is about a couple of months away, a month or two away. And we had invested in this opportunity about 3 years ago in the first round. We then supported them with 2 additional rounds. So we invested in them in 18-19, then again in 2020, and again in 2021. And those investments are up. The first round investment in terms of valuation must be up about 4 odd times. And the second and third are up about 3 times and 2 times respectively. So it is a high risk investment, but as you can see, the company has made significant progress from developing a vaccine technology to taking a product of that technology to the phase 1 trial stage, that's where you would be getting an opportunity to invest in this company. But we think that in the near to medium term, i.e. in the next 12 to 24 months, they will be firmly there in the market with live products, uh, uh, helping humanity address the challenges of these two diseases, influenza, which has been around the world for over 100 years now, and COVID, which could well follow the influenza pathway. So that's really what I have to cover in today's presentation. Thank you so very much for your patient hearing, and I'm happy to take questions now.
Thank you, Anil, for that insightful session. I'm sure our participants learned a fair bit about angel investing and about OneCrowd. A few questions from the audience. Rahul has asked, is there a hurdle rate for the investments, and are there any early exit options available?
Yeah, great question. No, there is no hurdle rate in the OneCrowd 0 to 1 fund. And the reason there is no hurdle rate is because each investor in the fund is taking an independent call of his or her own before her or his money is being invested in a particular opportunity. And the way to think about this is, if each of the opportunities that you're investing in, each scheme, is seen as a separate fund, then in the normal course, you don't get the benefit of set off. Because if I go and invest, for example, in fund number 1 of one investment manager and fund number 2, either of the same investment manager or a different investment manager, and so on and so forth, each one of these funds become unique, and the payoff of one has nothing to do with the payoff of the other. So profits and losses of one can't be set off against the profits and losses of the other. So the way to think of this is to think of each scheme as a separate, unique fund, and then ask the question, can I set off the profits and loss of one scheme against the other? And in the normal course, the answer is no. So if you were to get you were to ask for a hurdle rate on any particular scheme, then the question comes as to whether you would have the benefit of set off against other schemes. Because mind you, these are schemes that you are choosing. We only bring the scheme to your attention with all the attendant materials, etc. It's up to you to choose whether you want your capital invested there or not. So the other point to remember is hurdle is not a payout. So hurdle does not result in the manager paying you anything. Hurdle is only a benchmark over which the manager gets paid, right? Now, what we are doing is we're doing away with the hurdle because it's not a payout, because you're making the election yourselves, and then fusing all the schemes that you're investing in into one unique fund of your own. So call it your personal fund, your personal, you could be your own fund manager, creating a set of investment schemes, for your to suit your investment profile. But by fusing all of these schemes together and giving you the benefit of set off, we're giving you far greater economic value, because we get paid not just after a threshold is crossed, but we get paid only after your profits have actually paid for all your investments. And therefore, there is a much bigger economic benefit accruing to an investor with set off than with a hurdle. That's the reason why we don't have a hurdle.
Understood. Next one is there any small commitment packages available for small investor?
Yeah, so this 50 lakhs that you commit at the very minimum is a commitment over 5 years. And the way we have structured it is, of that 50 lakhs, you have to invest only 20% of 50 lakhs every year. That means in any given year, all you need to do is to invest 10 lakhs or in 2 schemes, or in 1 scheme, and you put in 10 lakhs. So it's very pocket friendly. because we have spread that 50 lakhs over a period of 5 years. And we think that at 5 lakhs per ticket, you'd be able to build a portfolio of at least 10 companies, below which I think you won't get the benefit of diversification. So the idea in putting in 50 lakhs is the minimum, and then calling for money in each investment at 5 lakhs a piece is precisely to help you build a portfolio that is also equally friendly on your investment pocket.
Question from Mukesh. After 5 years, what will be the management fees and how will you charge that?
So we don't charge any management fee after 5 years. To illustrate that, if you were to choose to make an investment in a scheme and you choose to invest the minimum ticket of 5 lakhs in that scheme, of that 5, let's call it 10% is taken out as fees. Now, in case the investment remains alive even after 5 years, we as managers continue to provide you the service of managing that investment, but we don't get paid for it with fees, at least beyond 5.
Question from Sanjay Kulkarni. After investment, do we get stocks in demat, same as unlisted?
So you will get units in the fund. These units can be dematted, but really the instrument that you would get are units in the scheme that you have invested in.
Last one is a partly philosophical question, which is, as a country system, are we mature enough for angel investing or HNI who do not have in-house expertise to evaluate the opportunity? In past, platforms like Grex had emerged for the same purpose, but today have disappeared.
Well, it's a very fair question to be asking, especially as the markets churn and different, call it different opinions begin to take hold. There was a point in time, 5-7 years ago, when I think people invested in startups and really had the benefit of a rising tide lifting all boats and getting out, and making a lot of money. That was surreal. In reality, any investing, whether you're in fixed income, whether you're in equities, whether you're in commodities, no matter where you are and how you invest, investing is a risky business. It's subject to sharp vicissitudes of the market, and there are lots of twists and turns that it takes, all of which was kind of subdued in the last decade, simply because of the loose monetary policies that were being pursued by most central banks, certainly the central banks that matter to the global economy. So that's a very, very good question that you ask. Are we mature enough for this kind of risk? I think in balance we are. And I say that only because we are also a country and an economy that has significant depth in human resources. And that's absolutely critical in the startup world, because most of the startups that we are investing in, most of the opportunities that we get to analyze are startup opportunities that are coming out of lots of innovation, lots of R&D, lots of trial and error. And if we do have that kind of entrepreneurial capacity in the economy, I think risk capital will follow. So I don't have a problem in finding risk capital for right kind of opportunities. I think what we need to accept as a community of investors is that these are long gestation investments that require a certain degree of patience, and importantly, in that timeline are bound to see a number of cycles in the market. And so long as the business model and importantly the entrepreneur can withstand those cycles, you've got a great investment.
Thank you so much, Anil. I think we've just exceeded an hour and the time that was allocated to us. So once again, I would like to thank you and thank our audience for attending this session. Uh, it's been a pleasure to have you tell us about angel investing, and I'm sure we've learned a lot. To the audience, I think the endeavor with this webinar was that at Jiraaf, we are trying to bring together knowledge about various asset classes to our partners and to our members. So we hope that you found this useful. In case you have any follow-up queries, or in case you would like to reach out for any other details, please do feel free to reach out to One Crowd or to Jiraaf, and we'll be very happy to address those queries. Once again, thank you all for taking out the time this evening. Thank you. And with that, we would conclude the webinar.
Thank you very much, Prateek, and to your team. We're grateful, and to each of you to have spent your evening with us. Thank you very much.